Welcome to the Financial Advisors Want to Know podcast, sponsored by Dominion Enterprise Services. I'm Catherine Tindall, CPA and founder of Dominion. We're a tax and accounting firm focused exclusively on serving advisors for their own tax planning and filing needs as business owners. At Dominion, we work alongside advisory firm owners to bring proactive strategy, clarity, and confidence to their tax planning so they can focus on growing their firms. The focus of this show is to cover different areas that I've experienced as a tax planner, working with advisor clients in their lives, building their practices. So let's get started. Hello, everyone, and welcome to the show. This is Catherine. On today's episode, I have with me Ben Douglas. He is an attorney who works specifically with investment advisors regarding regulatory work, client relationships, sales and purchases of advisory firms. So that's going to be a lot of what we talk about today. Working with public and private funds, conflicts of interest, and investor disputes. So you have a real deep expertise in the industry. Thanks for coming on the show today, Ben.
You bet. Thanks, Catherine. Appreciate it being on.
So we were talking a little bit in the pre-show, and part of how we got connected was I know both of us do a lot of work in purchasing and selling practices and, all of the things that come up with those lovely succession planning and M&A things that go on in firms. So I guess, to give advisors a little bit of background, usually when, you're working with firm owners, either on the buy side or the sell side, what's the general role that you take as part of, their exploration of, a potential sale or purchase, or kind of because for a lot of advisors, they've never, maybe working with an attorney like you for the M&A process is kind of the big, the first biggest time that they're really, having a, more integrated relationship and working. So could you describe kind of at a really high level, like how do you work with firms? Like what's your typical role look like, working with firms that are thinking about going through this process?
Yeah, so the core of my practice is being an ongoing outside general counsel for various financial services firms, particularly wealth managers and people running private funds. When it comes to sort of the M&A context, they all fit in together, because the things I advise my clients on to protect their businesses, to grow their businesses in a thoughtful way, obviously a way that doesn't expose them to regulatory risk or to private client disputes, meshes very well with how they want to position themselves for a sale. I, as part of my practice, I do a lot of M&A work. I have some clients that are growing by gobbling up, smaller firms, acquiring their businesses, acquiring their client relationships, and then bringing the principals and other key employees of the acquired firm on board. And then they just get integrated in and they go on their merry way, and the acquiring firm grows its AUM in that way, as well as through organic methods as well. And I also represent some smaller firms. I may be their ongoing general counsel for a while, or sometimes I meet them for the first time when they're really in the mode where they're getting ready to position the firm for sale, or maybe actually sell the business itself. And so what I'm doing when I'm representing the acquirer, the buyer, is really helping work with the CEO and the CFO, thinking very deeply about how to value the firm. I mean, at a very high level, do we want to acquire this? Is this going to mesh in well with the culture of the acquiring firm? And that's largely my client's concern. But I'll also weigh in, especially if I see some issues about how they've sort of potentially created some regulatory exposure that could potentially wash up after the deal. And then really taking a deep dive in their client relationships, both the legal aspects and the sort of more soft aspects of those relationships, and advise the executives of the acquiring firm on that. And conversely, when I'm working with firms that are in the process, or maybe looking out on the horizon and thinking about selling their businesses down the road, I'd be advising them on the same things, like, hey, you should be thinking about positioning your firm in this way. These are the kind of personnel you need to have in place. These are the way you can improve your client relationships, the legal documentation and other relationships that will make you more attractive to a potential buyer, either right now or maybe years down the road.
Yeah, and I think maybe for us to break up the conversation into two parts, to start with basically selling side, because I know
Yeah.
for myself and the work that we do, it's funny, the conversation I had right before this, us recording this podcast, was talking to an advisor about this of just, even if you're not intending to sell anytime soon, having that attitude of, okay, how am I being valued? What would I be dinged on? What are the areas in the business that aren't professionalized? Where are the risks that are living in the business? Because even if you're not selling, you kind of are selling that firm to your future self every year, because you're
That's a great
inheriting
way to
that
put it. Yeah.
business. And so the more that you can make it a more valuable asset for an external buyer, it's just making it a more valuable asset for you as the owner operator.
Exactly.
So I guess to talk on the sell side, when you're working with, say, smaller firms who are going through the progression of, thinking about selling, where do you usually recommend they start? What's the process? How early should they contact an attorney like you? Some of those kind of first getting started areas, what are things that firms should be thinking about?
Yeah, and just to step a little back from the question, and then I'll circle back on that. I emphasize this a lot because I've seen, not directly with clients, but sort of indirectly, people wait too long on this. A lot of
Yes.
a lot of the principals in advisory firms will say, I love what I do. I'm going to be doing it till I'm 75 or 80.
Yeah.
I'm only 55. Why should I think about selling the firm now? The answer to that question is maybe you're not ready to sell it quite now, but you probably should be selling it sooner than you think, and certainly far sooner than when you're even really serious about retiring. And the reason for that is that the acquiring firm, all they're buying are those relationships you have with your clients. And when they perceive that you as the principal of the firm or the multiple principals are really just want to get a payday and then go hit the golf course, that's going to make the firm a lot less valuable because they'll worry about the stickiness of those client relationships. The most attractive firms to buy are where the principals are really in the prime of their careers. So what I tell people is if you're in your mid 50s or up, you should be thinking about selling the firm, even if you're planning to work till you're 75 or 80. It's a lot of it is the emotional trade-off. You no longer have your name on the door. You no longer have the CEO title, and some people they just can't give that up, and I understand that. But if you're looking to really maximize the value of the firm for yourself, and potentially make your life a bit easier by taking off that CEO hat and really just focusing on what you love to do. It is really you can't start thinking about that too soon, and you can't even selling the firm more sooner than you might have thought when you were younger you would do. So that's something just to keep in mind. And in terms of the specifics of things to think about that will make a firm more attractive to potential buyer, obviously the biggest thing is the AUM. That's an easy thing to measure, like how many dollars under management. But that's a very superficial cut. And when I'm working with my clients on the buy side, that's just the very first thing we're going to look at, and then we're going to drill down well beyond that. And it's really the quality of the AUM is close behind the quantity. And there's sort of a Goldilocks, what I call a Goldilocks level of client concentration. You don't want all of your assets concentrated among 10 clients. That's obviously, there's a huge vulnerability. You lose one or two, that's a big drop. But at the same time, if they're spread out, around 1,000 clients that each have, just $100,000, yeah, there's still value there, but it's a lot less because obviously there's a certain cost of just dealing with a client regardless of their AUM. So I can't give you exactly what the right level is, but it's certainly somewhere in between that in terms of the concentration. And then a big factor is the characteristics of the clients. Their age is a big deal. How much, because a buyer is going to think, how much longer are these clients going to stick around? They may be loyal to the principal of this firm I'm buying, but if they're going to be passing away in 10 or 15 years, where does that leave me? And that ties into another important factor, which is what is your relationship with your client's family? What is if you have a 80-year-old client, have you already sort of brought in their, middle-aged children? Are those middle-aged children clients of the firm? Their young adult children? The more you can show that to an acquiring firm, the more they're going to attach a higher multiple to the assets that you have, because they will really think, yeah, these are sticky. This is an extended multi-generational family relationship, because otherwise your client dies and suddenly the money goes to their kids, and the kids already have their own relationships, or they've got their sister-in-law who's at a big wirehouse and who's been saying, hey, come and let me manage your money, and then that's gone. So positioning that now, and as you said, that's going to make your firm more successful even if you don't sell it for 10 years. And it's certainly going to make you a lot more attractive to a potential buyer. And then sort of related to that is, what's your current pipeline for growth? If you can show, hey, I've got feelers out, I'm very active in different community organizations that bring me a lot more clients, that I have ways to grow AUM from existing clients, and to show that that's been a steady trend. Again, that will also be good for your firm now and will make you a more attractive target for an acquisition down the road. And then internally, something to think about are how the personnel you have in place. And this may depend on the size of the firm, but if you're a firm that has multiple hundreds of millions or even billions of dollars, you're not going to be managing that just one person or even just the two principals. You're going to have different people in place. So you really want to think about whether you have what I'd call sort of a laddered portfolio of key employees. If they're all your age, then think, well, everyone's going to age out at the same time. So having people of different sort of professional experience levels, different ages, again, also helps you position your business for healthy growth in the future and makes you more attractive to a buyer, because they'll think, oh, we'll just bring all these key people over, integrate them into the acquiring firm, and all the clients will have a seamless experience and they'll stick around. Those will be very valuable assets to buy. And then just sort of general housekeeping, have good compliance policies, don't have regulatory problems, or certainly make sure that they're all properly resolved. Again, it's not a huge factor, because in typical deals, the acquiring firm doesn't actually buy the smaller firm. They just buy their business, so the liabilities of the firm are left behind. But it still will make buyers nervous when there have been problems, when there's threatened litigation or something like that. So this is one more reason to keep that as clean as possible. And a small thing, but also can make things more helpful, is the contracts you have, the advisory agreements you have with those clients. It's really great if they lend themselves well to an easy assignment. Obviously, you can't assign an advisory agreement without the consent of the client. But what you can do is the agreements can be drafted explicitly to allow a negative consent, meaning it says that if the firm changes ownership, or if the business itself is assigned, and we want to assign the contract to a firm that's buying our business, you, the client, agree that we will inform you of this, and if you don't object within, say, 30 or 60 days, that will constitute an assignment. By putting that in the agreements up front, it creates a lot less drag, really smooths up the process once the deal is struck and you're looking to actually close things out and transition the clients over to the buying firm.
Yeah, that's a really excellent point, because I think a lot of the friction I've seen because we kind of work through people through the transition, like the paperwork nightmare is like, if you can limit some of that, and getting all of everything repapered, everything, it's the more you can limit it, the better. So I guess a couple of other, I really liked kind of how you started your response to the question, because this is a common issue that I'll see as well with a lot of advisors, in terms of like, when do you really need to start thinking about this process in general, for them to realize that, really you want to sell way before you want to exit out of the business. And, I know I find a lot of times when I talk to advisors, especially when they're in later career, they get really burnt out. A lot of them are really burnt out by running both the CEO function, and they're still very heavily in the advisory relationships with the clients. And so for a lot of them, a lot of the love of their work has been burnt out because of having to do the CEO function at the same time.
Yeah.
I find others where, it's so dispositionally independent, right? Like some advisors, they really want to stay client facing for their whole careers. Other advisors, they prefer switching into that CEO and then mentoring their team kind of role, and not being as directly client facing. I guess for, advisors kind of in the stage where sale is more imminent. So maybe they've put together, had a valuation done, targeted these things over the past couple of years, really getting close to that imminent sale. What are some recommendations you have around how they should be thinking about who to sell to, how to source, a buyer, just any observations that you have when it comes to, evaluating the deal from their perspective? Because I know a lot of things like earnouts or just all the little caveats in the language can be more or less attractive. So maybe any general advice that you have for an advisor where they've gotten ready, they're ready. Now we're in the act of trying to sell the business process. Catherine here. Just wanted to say thanks for tuning into the show and hope you've been enjoying it. Since we're all at the mercy of social media algorithms, if you wouldn't mind rating the podcast on whatever platform that you listen to, I'd really appreciate it. And also, if you're looking to stay in the loop on current tax updates, what the firm is working on, and just the things that I think you as a firm owner need to be aware of when it comes to the world of tax, you can sign up for our newsletter using the link below. I only send out editions when we have really useful things to share or things that I think are important to have your attention and energy on. So let's get back to the show, and thanks again for being a listener.
So well, first I'd say just touching on your point about some advisors really want to kind of get back to their roots and managing their clients' assets rather than being CEO. Obviously, then it's very easy prospect to sell the firm, take off the administrative hats, and just get back to what they were doing in the first place and get paid for the firm that they've built. But for the ones who really want to be CEO, you can look at possibly an internal succession option. And those are approaches where, again, you just figure out ways to slowly transition the business over to the next generation, which again, it is a decade-long process of putting those people in place who will then slowly buy out the firm, and then you'd figure out that you as the selling owner would have some trail on that. But if it is external, if the motivation is I want to have less executive responsibility and just really focus on the wealth management side, the first thing you want to make sure is that you're going with a firm that has a really robust, effective platform that will truly take all of that administrative responsibility off your desk. So you have to do the due diligence on that. And then think about what could be additive. And one of the advantages of going onto a larger platform is potentially more offerings, access to different investment opportunities, maybe more robust reporting, just a whole variety, but better billing, things like that. So you'd want to do a deep dive and really see what's on offer for that larger firm that they can really make your life easier and make your client, and hopefully add some real value to your clients. So it'll be, you want the clients to feel that they're not losing anything, but better yet, you really want them to feel that they're actually better off in terms of what their opportunities for investments and just their experience as clients of the new firm. So that would be sort of on a base level, just sort of that due diligence. And then when you're getting down to brass tacks, the key issues that are always going to come up in an acquisition, obviously the number one is, what's the total price? How many dollars are you going to pay me to transition all of my business over to you, to sign it all over? But that's really just the beginning of the analysis, because there are multiple elements to that price. First of all, what's the split between cash and equity? Almost always, there's going to be a very significant part of that will be equity in the acquiring firm. Well, number one, they may not want to put out a lot of cash, but also they want to align the interest in many ways. When you, as their selling principal, come over, they want you to feel like an owner, not just feel like an owner, but be an owner. So that's going to be a part of it. And there are upsides and downsides to that. So you're going to have to evaluate, how do I think is this equity fairly valued? What's been the trend recently? What's the plan of this firm do I think that they're going to end up growing the value of the equity down the road? And when I ultimately leave, what would be the terms under their operating agreement for how that equity would be redeemed by the firm. So those are all things to think about there. And there's also the timing of the consideration. Typically, only a small minority of the total value of the deal is going to be cash on the barrel, just a wire that goes into your account at closing. And that's, as as anyone would guess, these assets are only as valuable as whether they stick around for many, many years. So typically the deal is we'll give you maybe something like 20% of the value up front, and then there's a lot of variability in what happens over the coming years, typically about 5 years, where you could end up making even more than you had sort of hoped if the deal goes really well, if the clients stick around, if the assets actually grow, both through not just through your management, but also through attracting even more assets in, whether new clients or additional assets from those existing clients that transition over. So those are all going to be have to be negotiated, and there's sort of levers. If you really insistent that you want more money up front, then there's going to be probably a lot less. The whole total value of the deal will decrease, because that means there's going to be more risk for the acquiring firm of what happens if the clients are not as sticky as you hoped. And then the flip side is, if you're willing to forgo a lot of the upfront money, you can negotiate for a much bigger earnout possibility. And again, the specific terms of those earnouts are going to be factor on the retention of your AUM, often specific revenue goals. There may be sort of growth requirements built in, so you may compare what's your revenue at year 2, year 3, year 4, year 5 versus a target annualized growth rate. There are going to be conditions. This is always going to be an issue that would be negotiated. What are the conditions that you get paid? There's always going to be that you continue to be an employee of the firm. You don't breach any of the covenants that you put into the agreement, which would include the typical ones: non-competition, non-solicitation, future clients, and that's very fair. The acquiring firm doesn't want you to leave and then get your clients to come follow you to a new firm. But for how many years out would that go? If you kind of think, well, if things don't work out, I would like to get back in the business. So these are all subject to negotiation. Again, you pull on one lever, you push on another. If you're willing to accept really harsh, strict terms for receipt of the payment, then you can negotiate for higher payment amounts. Those are all, again, there's no one right way to do it, but those typically are the areas that are the points of negotiation in a specific acquisition agreement.
Yeah, that's great. And I guess, maybe to flip the conversation a little bit, because, I'm also having this conversation more frequently, I feel like, than I used to. I'm running into a lot of maybe smaller firm owners who are interested in doing acquisitions and being on the buying side. For a lot of them, it's sourcing the deals can be the most challenging part, and then getting culture fit and actually working through the, what terms are going to work, and a lot of the, timing with the existing head advisor or previous owner. What are some recommendations on the buy side do you have when it comes to, approaching the deals or approaching an acquisition, that maybe they're not aware of and that we kind of haven't hit from the perspective of the selling side so far?
You need to, definitely do a very deep dive look at the culture of the firm you're buying, and make sure that they're people that you want to bring in to your firm. I've seen deals go badly, after they're closed, when it just was not a good culture fit. It wasn't really necessarily anyone's fault, but the way the new people in the acquired firm just want to do business, how they want to interact with their clients, how they want to interact with internal administration, just does not gel well with that firm. So I think in both directions, you're going to need to have some very specific conversations about what post acquisition life, day-to-day life would look like.
Mm-hmm. And then in terms of
doing the
structures,
asking around for about what are firm, asking around in your network about what are firms that really fit into the culture we have, the culture we want to grow, not just who's got a bunch of AUM and they're looking to sell.
Yeah, yeah, absolutely. And then I guess in terms of some of the, for maybe advisors who are more junior, where they're looking to do an acquisition where it's going to be a substantial part of the business going forward, what are some things that maybe they should be thinking about, or any like red flags, or, for someone who's not very experienced in the realm, that they should be aware of when they're thinking about, whether or not they should do an acquisition in the first place, or, how they should be structuring things?
Well, I think that they need to be very sure that they have built out their infrastructure, their compliance, their accounting, all of that internally really well beforehand. You don't want to be building the proverbial airplane after you've taken off. That does require a certain, kind of a bet, sort of betting in advance and building out that infrastructure before you go out and doing these acquisitions, because inevitably there will be some cultural growing pains as you bring them on. So you don't want to have actually the infrastructure getting creaky when you say if you increase your AUM by 80%, and you need to make sure that you've really got a lot of slack capacity in that, and that you're definitely, your compliance and legal should be part of that. Really thinking through: are there going to be new issues that come up? Are there clients that we are going to be taking on that may have some regulatory issues? Like, if it depends if you're trading in individual stocks. Are some of the clients senior executives at public companies, where that could create some problems around avoiding inside trading? So just really think all that through, and make sure, again, you've got an infrastructure that's easily robust enough to handle the assets that you're bringing on board.
And I can say a little bit from the, the tax and accounting side on this as well, where I will see advisors that they don't realize that there can be some really significant income tax differences between the deal structure. So, really making sure before you're even doing like an LOI or anything like that, that you have a sense for how much bandwidth you have financially and what's going to work, because especially if you're doing something like a stock acquisition where you're not getting amortization on that every year, you're basically you're going to have to pay for this acquisition from post-tax dollars. It makes it significantly more expensive to buy it versus, if you're able to do a partial book acquisition or just buy the client assets or something like that, where you can get a write-off that's also timing at the same time of the payments. So there's just a lot of that, where having a lot of modeling done ahead of time so that you know what you can afford, how the cash flow is going to work. And then even things like, okay, if we have a market pullback and revenue drops a bit, how much tolerance do we have on this acquisition where it will continue to be paying for itself versus not? Or if we lose a key team member on, this new team because they don't come over in the transition or something changes, how can we weather this from like a capacity standpoint? A lot of those kinds of moves. It's good to just even have a sense ahead of time, kind of where the risk is before you get serious in some of these. I've seen people be shocked when they do it after the fact. Yeah. Well, thank you so much, Ben. Is there anything else that we didn't, any big red flags or final thoughts that you want to share with the audience before we wrap things up?
No, well, I just emphasized my point from the beginning that it's never too soon to start thinking about this, even if retirement is long away on the distant horizon. It's always a good time to think about this. And as you said, the same steps you take to make your firm just a better firm for you to run, that you're giving to yourself, to your next year's self and your next decade's self, are pretty much the same things that will make you a more attractive acquisition target down the road. So it's just one more reason to do all the tune-ups and to work with you on improving internal processes.
Yeah, absolutely. So for those of you who are interested in getting connected with Ben and learning more about the ongoing work that he does with firms, we're going to post his contact information below. for you to be able to get in touch with him and learn more about kind of how he works with firms and then just the different areas, because like you mentioned, Ben, this M&A is just one small slice of kind of the work that you do with firms and that integrated counsel work. So for those of you interested, we're going to post that information. And then for myself, I'm always interested in hearing about what you thought about the episode, any feedback or ideas for future episodes, or what really stuck out to you in this episode that you found valuable. So thank you again, Ben, for coming on the show. Appreciate you making the time and really enjoyed the conversation.
Thanks, Catherine. Yeah, it was great. Thanks.
Thanks for listening to the Financial Advisors Want to Know podcast, again, sponsored by Dominion Enterprise Services. If you found this episode valuable, I would love to personally hear from you. Connect with me on LinkedIn and send me a message. I'm always interested in your feedback, future episode ideas, or questions you'd like to see covered in a future episode of the show. And be sure to subscribe to our monthly tax update newsletter, where we share timely tax insights and planning considerations specifically crafted for advisory firm owners and what we share to our own clients. We'll see you next time.